Welcome back, best ever listeners, to the Horizon podcast. This week, I'm going to focus a little bit on the new tax laws, tariffs, and maybe a little bit about what I saw in the jobs report that came out about a week ago. I'm Chang, and I've been active in commercial real estate for most of my life. And since 2007, I've had the opportunity to lead the research and advisory team at Marcus & Millichap, the nation's leading commercial real estate brokerage company. Now, I must mention, as I do each week, that I am doing this podcast independently. And what I say on the show does not reflect the opinion or position of Marcus & Millichap. You know, I got a really quick, funny story to tell this week. I was talking with one of the analysts on my team, and he was focusing in on some trends. And he said, I listened to your podcast last week, and, here's what I found interesting. And I was like, gee, I didn't realize you even knew I had a podcast, and I hadn't promoted it inside Marcus & Millichap or with my research team. It's kind of my side gig, and I do it for fun and in partnership with the best ever team. But I was just excited that one of my analysts had actually spent the time and found my podcast and had some interesting feedback about one of the sessions I did. So welcome, Robert. Thank you for joining me on my podcast. So that said, any of you who want to reach out and send me a note on LinkedIn, if you have an idea, something you'd like me to cover, any questions you may have, shoot them to me on LinkedIn, John T. Chang. You can find me there. Follow me. I have videos posted there that I do on behalf of Marcus & Millichap. But yes, just let me know what's on your mind, and anything you'd like me to talk about or guests you think I should have on the show, let me know. So this week, as I said, I'm going to start in with the new tax rules. And, the new tax law was just passed, and there's a lot of content in there. And what I found most important, well, there's a lot of facets actually, but they extended the opportunity zones. They added in the accelerated depreciation. They expanded the LIHTC investments so that there will be more affordable housing under the tax credit plan. And so there's a lot of things that are positive for commercial real estate. But I think as I wrote in a piece I did for the Urban Land Institute, there's one element of this new tax provision that I think is really, really important. Before I get there, I'll talk a little bit about what's going on with the LIHTC and some of the other things. So low-income housing tax credit, basically they increased the funding for that, and they made it easier to get the bonds set for those, which will pretty significantly increase the construction of low-income housing under the tax credit plan. That's a real positive for investors because LIHTC properties have tended to do very well over the years. They tend to fit a nice niche. They tend to perform well. Those tax credits are nice for investors, and those properties have been pretty sought after. Perhaps on another time, I'll get into some more of the details about LIHTC, Section 42 affordable housing. But basically, it's a great program for adding more housing. I think I'm really in favor of the government putting more resources behind that program because in my opinion, it's one of the best performing low-income housing programs out there. It works for investors. It works for the developers. It works for the investors in the property themselves. So that is a program that's done very, very well. The opportunity zone is another big deal. And that one, we won't have the new program until 2027. I think there's a lot to get ready for that. There is going to be new census tracts. There's some new rules in there. They created this on a rolling 5-year basis, and it's a permanent program now. Whereas in the 2017 Tax Cuts and Jobs Act, it had a limited duration. It was kind of a one-off thing. But basically, the advantages of the opportunity zones is that investors who are not in real estate, right? Because if you're in real estate, you probably wouldn't use this aspect of it necessarily. But basically, if somebody has a lot of capital gains. They sold a business. They sold a bunch of stock. Maybe they had stock options and they went out and sold them all and they have a big windfall and there's a capital gains tax associated with that. One of the things that the opportunity zones allows you to do is take that money, you put it into an opportunity zone fund, and it defers those capital gains taxes for 5 years. And it gives you a step up basis. Now, under the old plan, there was a series of step ups, one at 5 year, one at 7 year, one at 10 year, I think. Under the new plan, there is a single step up basis after 5 years of those capital gains of 10%. So say you had a $10 million windfall and you're going to pay taxes of $2 million. Now you're only going to have to pay taxes on 9 million of that. So you only pay $1.8 million in taxes. So you save $200,000 by doing this. The other advantage is that the earnings on the opportunity zones after, I think, 5 years, the earnings, the capital gains, the profits on the money you invest in the opportunity zones is tax free. So that's a big deal. It's a great opportunity, but that money is invested into specific regions that are designated by each state that are in a distress system or distressed, or they have lower income and they're trying to fuel additional development. So there may be more risk. You're going to have to look at these things carefully, but it's a great program for bringing more capital into commercial real estate. So that is great. That is being renewed. The new plan is scheduled to go live in 2027. And it will be permanent and on a rolling 5-year basis where those programs are operating. So good deal there. The accelerated depreciation I've talked about in past podcasts, and essentially you're going to go in and do an evaluation of the property, identify anything that has a depreciation cycle of 20 years or less. And those things you can write off in year one. So you go out, buy a property and you get the study done, and then you get a big tax write-off. And my point has been that if you do this and you have a property that you're buying that may be really marginal, maybe super thin, your cap rate is right on top of the rate of your financing. You may even be slightly negative on your leverage on that deal. And this will give it a boost in year one, maybe for a couple of years, where your taxes, you don't owe any taxes because of the depreciation. And that will make a big difference in those properties and may move it into positive territory. So my argument is that there are deals that may have been very marginal before this new law went into place, and those are they'll make sense under the new tax rules, or they'll get more interest under the new tax rules, and investors may find opportunity there. Also, the same is true with value add investments. The Section 179 accelerated depreciation of 100% means that things you would buy for a property as you're remodeling it or adding to it or putting in new appliances or whatnot, those things, instead of depreciating them over their expected life, 5 years, 7 years, 10 years, whatever it is, are going to be, you can write them off 100% first year, right when you buy them, up to $2.5 million, which is higher than it used to be. I think it was either $1 million or $1.2 million was the Section 179. Again, I'm not a tax expert. Do not rely on me for accurate tax advice. I'm trying to speak to the real estate side of this thing. These are all tax rules, and I'm trying to really focus in on what it means for real estate investors and investing. But when it comes to the actual accounting, please consult your accountant or tax specialist, because that is not me. All right, that said, so here you have all of these things: more light tech development, opportunity zones, accelerated depreciation. But as I put into this article that I am going to be, that will come out with the Urban Land Institute, is that these new rules were made permanent. And that is super important, because over the last however long, certainly the last decade or so, a lot of the tax policies have been short term. They basically create a policy and light a fuse and say, yeah, this is a great policy. Go ahead and use it until the fuse runs out and this program blows up. That's what it was with opportunity zones. It took a year for people to figure out how the opportunity zones even worked when they were signed into law in 2017. And the fuse was already burning on your ability to get those step-up bases. The funds that had to be created took time, and you got to find the properties. It requires development. You have to have contractors. That was a long process that they were cramming into a relatively short period of time. And again, the accelerated depreciation put in place in 2017, right? That was phasing out. We were going to be at a 40% accelerated depreciation this year. Last year was 60. The year before that was 80. But what that did is, in 2021, 2019, you had 100% bonus depreciation. There was a massive incentive to get a deal done while that program was in place. The tax advantages were burning off and there was urgency to it, which is great because it got people to do things. However, it makes it difficult to plan. And again, same thing with LIHTC. They made this permanent. These new percentages and the new targets and the new allocations is permanent. Nothing's permanent with the U.S. government, right? This could always change. But the thing is it will take an act of Congress to change it. So this is right in the crosshairs of this program, the horizon, the long-term perspective. Up until now, a lot of these policies, you really could not plan long-term based on these. These were one-off deals. You would go out and say, let's do an opportunity zone, and you create it and you launch it, but it's a one-off deal. And now under the new programs, now with these accelerated depreciation, with these LIHTC programs, with all of these things, they're ongoing, which means you can set up an entire company centered on a model. This isn't a one-off thing. You could do an investment fund solely focused on opportunity zones, because it's going to be an ongoing program. You can launch fund after fund after fund, and each will have its own cycle. But you could become an expert in this thing, where that really wasn't viable under the old rules because it was a one and done, right? The same thing is with LIHTC. LIHTC is going to spur a lot of additional development, because even though the cost of development is higher, the cost of materials is higher. The tariffs are certainly going to take a bite. The labor shortages are going to be challenging. But LIHTC has certain built-in advantage, a lower cost of financing and some other features that really make it work. So we may see a boost in affordable housing construction under the LIHTC program. And I think that has some legs to it, because there's certainly a shortage of affordable housing in the U.S. Last time we ran the numbers and everybody's got their own way of doing this, but somewhere around 3.5 million housing units shortage. And that's been the case for years. Even though we had record apartment completions over the last few years, we still not moved the needle. So this is all favorable because of the long-term implications of it. It reduces uncertainty. Like I said, you could do an entire business plan around any one of these programs and write it out for a long-term cycle. And you could ride that pony over and over again. So that's what I think about the new tax rules. They're finalized. I think Mark Smilchap, my team just put out a couple of reports. You can access that on marksmilchap.com. So that's readily available out there if you want to get the nuts and bolts of the new tax rules and what they mean for commercial real estate, right? I don't get into the Medicare, Medicaid, or any of the other social issues or any of the other programs. This is strictly with regard to the real estate programs and how the policies affect real estate only. So I sidestep any of the social aspect or the public policy per se. Really, it's just about the real estate in those reports. So go ahead and go download those. There's no charge. Just go to marksmilchat.com, register, If you haven't already, log in, you can get the report. And so that will put you on the email distribution list for other research if you choose to do that. The other topic I want to talk about is tariffs. I brought this up last week, right? That 90-day extension burned off on July 9th. And, I posed the question last week, what happens when that 90-day extension burns off? Are we going to raise the tariffs or what are we going to do? What happens next? And we found out now what happens at the end of the 90-day extension, which is another extension. But they mean it this time. Damn it. Basically, so the Trump administration sent off letters to various countries, I think 21, 22 countries, and said, hey, if you don't deal with this now, your tariffs are going to go to whatever, 20%, 25%, 30%, 35%, depending on the country. I know South Korea and Japan, two of our larger trade partners, I think they're like numbers 5 and 6 down the ranking, were targeted with 25% tariffs. So this is going, I don't know what happens next, but I've said it before. I believe the tariffs will be inflationary. We haven't seen it yet. It's not showing up in the big numbers. Yes, we've seen it on musical instruments and sound equipment and some appliances. It's starting to show up there. But if we really put 25% tariffs on everything we bring in from Japan and South Korea and 35% on China, we keep threatening to beat up on Canada and Mexico and move those tariffs up to 25%. They are 25% except for things under the USMCA agreement. I just heard something the other day. The tariff on tomatoes is going to 35% as it falls out of the prior agreement. Those coming from Mexico, of course, then that's something like 80 or 90% of the tomatoes we eat in the United States. This is going to have an effect, guys. It's not here yet, but it's coming. I'm pretty darn sure. So I believe that this is going to have a significant inflationary impact at some point. On top of that, they've announced that they're going with 50% tariffs on copper. Now, I understand that a lot of copper has been front run. I just heard something the other day that we have basically about a year supply of copper already in warehouses in the United States. So again, this isn't going to have a dramatic immediate effect, but it has potential for a long-term effect, just like the 50% tariffs on steel and aluminum. Those are going to drive up costs. I mean, you think about it, if you're building an apartment building, you have copper wiring, you have copper fittings. This is going to get more expensive. You may have the steel and nails and screws and all of that, the use of aluminum. Think about the appliances going into an apartment building. Think about, all of the components. They're talking about raising the lumber tariffs on Canada. I've heard numbers of around 35%. That will be a big hit for multifamily construction. If you shift over and look at some of the other things like retail construction, which is still limited, office construction is still limited. We're seeing a taper on the self-storage construction. We're seeing a taper on the industrial construction. But nonetheless, anybody who chooses to go out and build something today is going to face a more expensive development cycle. That it's just going to be more expensive to build because of the tariffs. And if this creates inflation, as I believe it will, then that just makes it that much harder for the Fed to reduce rates. I mean, Chairman Powell said, he was in Congress. He said, look, if we didn't have these tariffs in place, we probably would have lowered rates already. Now, I don't know if I necessarily believe him. Maybe that was a political statement because honestly, there's not a lot of reasons to lower the tariff. Lower the 10-year treasury, the overnight rates. There's no real reason to lower the rates today from a Fed policy standpoint, right? Keep inflation down, keep unemployment down. That's their job. Those two things. They just have a very simple job. It's just two things, right? I wish we all had something so simple. The unemployment rate is 4.1%. Now, I'll get into that in just a second. So the unemployment rate's already low. Why would they want to reduce rates? Tariffs or no? If we didn't have tariffs, why would they want to lower rates? They may go and put in some token rate cuts just to kind of quote unquote normalize it to a stabilized rate. But the fact is that we're far better off holding the rates where they are, honestly, in order to be able to have dry powder if it's needed to help battle a recession. And a recession risk remains elevated. I know a lot of economists have reduced their recession forecast. I think it's running around 30% probability right now, 35%. But I think that the risks are still there. So here we have all these tariffs. I do want to mention one other thing, which I just caught my eye. It's not really relevant. I'm sorry. But President Trump threatened Brazil with 50% tariffs the other day. And look, we have a trade surplus with Brazil, $6.8 billion trade surplus. And basically, President Trump said, quit chasing after the former President Bolsonaro, who allegedly tried to stage a coup and is being put on trial. And so we're threatening to put tariffs on a foreign country because they're enforcing their laws. I don't know about you. That kind of leaves a bad taste in my mouth. Anyway, I'm off of that. Moving on. Looking at what's happening with jobs a little bit. Like I said earlier, unemployment rate's still low, 4.1%, but the labor force shrunk. There are fewer people looking for jobs. Okay. So because there's less people looking for jobs, and quite frankly, the unemployment rate methodology, the survey methodology is junk. All right. That's just not very good. It's the official measurement, so we have to use it. But it's not a very good tool for measuring that. And so you have that piece. We created jobs. We had 140,000 jobs created, which is better than everyone thought. But again, archaic methodology. Remember, the jobs numbers are quote unquote seasonally adjusted. And if you drill down into the numbers, apparently there were a whole bunch of teachers hired in June, which is not the case. They're just normalizing the numbers. So again, that's an estimate, surveys of companies, surveys of people, and they try to figure out how many jobs are created. Again, not a good metric, but official. It is the official metric, which means it is true by default, even though we know it's structurally flawed. So here we are. We created a bunch of jobs. The unemployment rate's down. All is good, right? No, not necessarily. If you look, drill down underneath there, right? If you look at it, the CEO sentiment has fallen dramatically. Private sector jobs, if you take out all the public sector jobs in the reported numbers, private sector jobs, job creation is actually running a little bit negative. The CEO sentiment's down. Leading indicators coming out of the small business surveys suggest that hiring is flattening out. If you look at the JOLTS data, the quits rate is low, meaning people are not quitting their job to go get a new one. They're sticking where they are. That's another sign that the employment market is softening up. So all of these things suggest that the interest rates are that the Fed is going to hold interest rates higher for longer. They want to hold that dry powder in case, to try to stave off tariff-driven inflation, to try to keep dry powder in case we do start moving into a recession. So at least as long as Jay Powell is the chairman of the Federal Reserve, I would continue to argue that rate cuts are unlikely. Now, if Chairman Powell caves and he, gets out under pressure from Trump, then whole new matter. And quite frankly, if they put in a very dovish person and they start cutting rates, I become even more fearful of an inflation spike. Because right now we have an isolated issue. We have tariffs that are kind of creating the inflationary pressure. That's one thing. But if you add on low interest rates and companies start borrowing money and throwing money into growth, and we start growing the economy really fast, that's also inflationary. Now you're doubled up. Now you have tariffs and you have inflationary pressure from growth. So yes, we would have accelerated growth, but that inflation would be an ongoing problem and force the Fed to do what they did last time inflation went up, which is spike rates in order to get that inflation back down. I'd rather not deal with that cycle again. It was bad for business. That was bad for everybody's business. So there you go. Looking out at the horizon, get to know the new tax rules. Download the report from Mark Smilich app, drill deeper, go talk to your real estate tax advisor, really get a handle on what these new rules are. Because as I said earlier, these things are coming in and being put in place for the long term. And that means you can plan for the long term. I know a lot of the people who listen to this podcast are very entrepreneurial. And if you look at these programs, there are going to be opportunities that are created for long-term business strategies that involve commercial real estate, that involve investment. And I think there are some opportunities that are going to be available. And you're not going to be limited to 4 years or 5 years or 6 years or whatever it is. The phase-out period has historically been. This is a long-term strategy that you can put in play, built on the new tax rules. So take a look, see what you find there. The economy ahead may be a little bit rocky, right? You hear it in my voice and what I say, what's happening with tariffs, what's happening with these economic policies and so on. But it's going to be bumpy, right? We don't have clarity on what the policies of our country are going to be, aside from the taxes, which means it's going to be bumpy. But when you look at commercial real estate, when you look long term, when you look at the demographics, they're positive. Housing demand is healthy and strong and going to remain robust, in my opinion. Retail demand will be healthy. As long as construction doesn't get out of hand, retail is going to do just fine. I think that office is facing a little bit of a turnaround. I think a lot of the young people coming into the current marketplace are going to be much more open to working from the office full time. I'm seeing that with my own team. I'm seeing that across the industry. Younger people want to be in the office more frequently in general, just because that's how they build their career and get to know people and build their relationships. So I think that there is an opportunity there in office as well. Again, assuming we don't get into a construction wave, which there's no way that's happening. Industrial, the slowdown in construction is positive. I think long-term demand is going to be good for industrial space. However, the tariffs are going to crimp that, especially in the Western United States. And then there's the demographic specific products, things like medical office, seniors housing. I think those are still very favorable investment opportunities going forward. So there you have it, best ever listeners. I want to thank all of you for joining the Horizon podcast today. Of course, I will be back next Sunday and every Sunday with, whatever happens to be on my mind, I guess, is kind of how this is shaping up. But hopefully you're all getting some valuable insights. Remember to look me up on LinkedIn, send me a note, connect with me. Give me your thoughts on anything you'd love to hear about that you think I might be able to drill into. I'd really like the feedback because, there's always something interesting I haven't thought of at all. So reach out to me. So thank you again. I'll be back next Sunday. And so until next week, keep your eyes on the horizon.